Every time you sell a Vietnamese stock, the government takes a cut, not on your profit, on the entire transaction value. It's called the securities transaction tax, and the rate is 0.1%. Small number, easy to ignore, but if you trade actively, it adds up faster than you think. Let's be precise about how this works. In Vietnam, every time you sell a stock, you pay 0.1% of the total sale value as tax, not 0.1% of your gain. 0.1% of the gross transaction amount. So if you sell $100,000 worth of Vietnamese stocks, you pay $100 in tax. Automatically, no filing required. It's deducted at the point of sale by your broker, and it applies whether you made money or lost money on the trade. Profit doesn't matter. The tax is on the sale value. Full stop. Now, is this unusual? Actually, transaction taxes on stock sales exist in many markets. Hong Kong charges 0.1% stamp duty on both buys and sells. The UK charges 0.5% stamp duty on purchases. South Korea charges 0.18%. Vietnam's 0.1%, only on sells, is actually on the lower end globally. The US has no transaction tax on stock trades, so for American investors, this is a new concept entirely. But in the context of global markets, Vietnam's rate is competitive. Here's where it actually matters. If you're a long-term investor, buying and holding Vietnamese stocks for years, 0.1% on an eventual sale is negligible. It barely affects your return. But if you trade frequently, if you're buying and selling Vietnamese stocks regularly, the tax compounds into a real drag on performance. Let's say you turn over your portfolio 4 times a year. On a $100,000 portfolio, that's $400 in transaction tax annually. Not catastrophic, but not nothing either. This is one reason why Vietnam's market naturally favors patient, long-term investors over active traders. The tax structure nudges you toward holding. There's one more tax foreign investors need to know about. Dividends from Vietnamese stocks are taxed at 5%. This is withheld automatically. You don't need to file anything separately. 5% on dividends is low by global standards. For context, the US withholds 30% on dividends paid to foreign investors unless a tax treaty reduces that rate. Vietnam's 5% dividend tax is straightforward and investor-friendly. Combined with the 0.1% transaction tax, the overall tax burden on foreign investors in Vietnam is actually quite reasonable compared to many markets. 0.1% on every sale, 5% on dividends, both withheld automatically. No filing, no complexity. Vietnam's tax structure for stock investors is simple. It rewards patience, it penalizes hyperactive trading, and compared to most markets, it's not punishing. Know the numbers going in, build them into your return expectations, and stop being surprised by costs that were always there, just undisclosed. In the next video, I'll tackle one of the biggest myths about Vietnam investing, that it's too risky for serious investors. We'll look at what the data actually says. Follow the channel so you don't miss it.